My name is David Bell. I'm a chartered accountant and tax consultant with Davies and Associates. I'd like to welcome you today to private client webinar entitled Reform of Non-DOMs, a Guide. The webinar will last around 40 to 45 minutes and there will be 15 minutes at the end through which you can pose questions to us. We've also got 2 polls within the webinar which will be interesting to get your feedback and views on. At the Summer Budget 2015, George Osborne announced a raft of reforms that will affect the taxation of UK resident non-DOMs. There were 3 key elements to the package of reforms. The first being the end to permanent non-DOM status for income tax and capital gains. The second being the removal of tax advantages for those with a UK domicile of origin born in the UK who subsequently leave the UK to acquire a domicile of choice elsewhere before returning to the UK, the so-called boomerang non-DOMs. And the final important element was a reform to the taxation of UK residential property owned through offshore structures. A consultation was published in September 2015 and further detail was published over the summer and August 2016, which provided more detail on residential property and inheritance tax. I'm joined today by Mark Davies, Davies and Associates. Davies and Associates is a London-based boutique focused on providing tax advice for UK resident non-DOMs and those investing in the UK. Mark has over 20 years experience in advising such clients. The firm has won many accolades, including recently being finalists of STEP's Boutique Firm of the Year. Mark has also won Tolly's Tax Commentator of the Year and has recently won Tax Accountant of the Year with Spears Wealth Management. Mark, can I ask you to explain what the deemed domicile rules are?
Thank you, David. Well, I think it'd be helpful if we just recap briefly on what the rules were and then take a look at how they're evolving and still evolving. Well, I'm sure, as you know, we have the remittance basis. And what this means is that a non-DOM can claim the remittance basis, and in doing so he pays tax on his UK sources of income and gains, but he doesn't pay tax on his foreign sources of income and gains as long as he doesn't remit them to the UK. This rule has been around since 1914, and it wasn't until 2008 with the Finance Act 2008 that the then Chancellor, Mr. Osborne, decided to introduce a new concept. And this new concept was the remittance basis charge. Now what this meant was that instead of a non-DOM being able to elect for the remittance basis indefinitely, he had to start to pay some money for it. So it started very simple, with someone having to pay £30,000 per annum to claim the remittance basis once they'd been in the UK for 7 out of the previous 9 tax years. Subsequent Finance Acts tweaked this, and so we then had a £60,000 remittance basis charge for people who'd been in the UK for 12 out of the previous 15 tax years. And then we had a £90,000 remittance basis charge for those persons who became resident in the UK for 17 out of the last 20 tax years. Now what this meant was that a non-DOM could effectively pay very little tax indefinitely. There was a deeming tax rule for inheritance tax, but it only applied to inheritance tax. So those persons who were resident in the UK for 17 out of the previous 20 tax years, their worldwide estates would become subject to UK inheritance tax. But this didn't apply to all the other taxes. So what we had was, in the Summer Budget 2015, George Osborne's surprise summer budget, he decided to change the rules and brought about an end to non-DOM status, or permanent non-DOM status. There were 3 key changes. The first one was to bring about an end to boomerang non-DOMs. Now this affected people who were born in the UK, who subsequently left the UK and acquired a domicile of choice somewhere else, and who then subsequently came back to the UK. Now the government had a considerable amount of embarrassment with Lord Ashcroft, with his non-dom status, and so this was quite pointedly directed at people like Lord Ashcroft, who had a domicile of origin in the UK, who had left and then came back. So this provision was very pointed at them to prevent them from having any tax benefits once they return to the UK. The second change was to change how residential property is taxed. And this is one in a long line of steps where the government is trying to dissuade foreign investment in residential property. The specific change is that non-doms who own residential property through an offshore vehicle will now be subject to inheritance tax after April 2017. The biggest change is the attack on long-term UK resident non-doms. And this is going to apply to people who are resident in the UK for 15 out of the previous 20 tax years. It will also be an alignment so that income tax, capital gains tax and inheritance tax will now all have the same rule. So instead of the deemed domicile rule for 17 out of 20 tax years for inheritance tax, it's now going to be 15 out of 20 tax years, and the income tax rules and the capital gains tax rules are now going to align as well. The government was also at pains to say that there'd be a measure of protection for offshore trusts. And as we shall see in a few moments, these protections can very easily be lost, and it requires some considerable skill and maintenance to make sure they continue to be protected. A consultation was launched in 2015, and it was almost immediately withdrawn because it coincided with Lord Ashcroft's memoirs. So it was more of a non-doc than a con-doc. So it came out, withdrawn, put back out again. And this gave us our first sight of knowing a little bit more about what was actually going to happen. In short, what they said is that non-doms will be taxed on their worldwide income and gains, but what's in a trust, as long as it stays in a trust, wouldn't become taxed. So then we had Budget 2016, and this said we would have a rebasing election for people who become deemed domiciled. Now this of course was very welcome news for people who can't really afford to have a trust structure. There then followed a period of quiet where most of us thought with Brexit the government would have too much to do, and many of us thought that the non-dom reform would not come in. But then in a kind of surprise, there was a further consultation launched in August 2016. It should be noted that this is a further consultation. It's not a definitive position of what the government's rules are. It is just a further consultation. And so what we actually see when we see the final legislation, perhaps in March or April in 2017, it may look very different to what we have now. So I'm going to start by talking about residential property. What this covers is it covers overseas companies that are close companies or partnerships where there are 5 or fewer people who control the structure. It's going to apply to all residential property. The definition of what exactly will be a residential property doesn't seem to be completely decided, but it seems to be likely that it's going to follow previous definitions. So it'll cover dwellings, but it won't cover things like prisons or care homes. Right, so the proposed rules are not going to affect commercial property. And where properties are for mixed use, so maybe a shop with a flat above, then there's going to be a sort of apportionment for that bit relating to the dwelling. So the end position is that companies that are offshore owning residential property are now not going to be necessarily the most tax efficient structures, because they're potentially going to be subject to non-resident CGT. There may be annual tax on envelope dwellings, and from 2017 onwards, we're going to have inheritance tax on closed companies. So that might be the final nail in the coffin for offshore companies.
So in light of that, for those who wish to invest in UK residential property, is there a way of doing it tax efficiently?
Well, yes, David, I think there is. I think people are going to have a range of options. The cheapest option might be just getting some insurance, and that would then pay the inheritance tax charge if it turns out to be payable. We should also think about how the structure is financed. If you have an allowable debt, then that can be deductible against the property. And so only the net value of the asset will become subject to inheritance tax. And finally, there may be a place for other things, such as collective investments, investment bonds, QNUPs, those are qualifying non-UK pension schemes. These may be all vehicles that might be used to buy residential property. And we may also need to think about, well, is residential property the right investment? The rules only apply to residential property. They don't apply to UK commercial property. So perhaps we'll see a drift from people investing in residential moving into commercial. I'm now going to look at long-term resident non-DOMs. A few things have changed. So the most surprising change is that the government has brought in the concept of being able to unmix a mixed fund. Now, this is very difficult to do in practice. And what the government is allowing you to do is that where you have a mixed bank account or similar, you can unmix it into its constituent parts. It does need to be a bank account or similar. So if you've spent the money and put it into some sort of investment, you're going to need to sell that investment, convert it back to cash, and then unmix the cash. What we don't know is what kind of analysis are we going to have to do on that mixed fund. The government hasn't told us, do we have to do it on a line-by-line basis? We don't know if it can be apportioned on some sort of just and reasonable basis. But either way, it may be quite difficult to do if we're looking at 20 years of transactions to analyse. There's some simple tax planning that we can do if we do unmix. At its most simple, segregation is all about just knowing what your pot of clean capital is. And once you know what it is, everything else you have can be in some other vehicle. If you have a more complex arrangement, somebody might want a clean capital account. They might want an interest account to collect the income from that capital account. And they might then put the rest of their investments that are mixed, foreign income, mixed gains, they can be put in some sort of vehicle or wrapper. So I'm thinking things like an investment policy, some sort of collective investment, maybe even a trust. So there are going to be options for people. If people wanted to do more with their clean capital, then there's nothing stopping you borrowing against your clean capital and then using the borrowings to invest in foreign assets. So these foreign assets, as long as they're not UK source or UK situs, they can grow outside of the UK and be used to service the loan. Once they are deemed domiciled, of course, they may need to put those assets into some sort of wrapper, and I've already mentioned what those might be.
Perhaps we might pause for a moment to do a question for the audience. Do you think that the ability to unmix mixed funds will be a useful relief, or one where professional costs outweigh the benefits to the client? You can click yes, no, or don't know.
Right, so we got the result. That's interesting. I think our view is that most people are going to find it very difficult in practice to unmix mixed funds, purely because there may be 20 years of transactions which will be very difficult to unravel because the data simply won't be there. So David, probably the most significant change and the most significant planning opportunity is the introduction of the rebasing election. This is going to mean that non-DOMs who become deemed DOM can elect to pay capital gains tax on disposals of foreign assets using a base cost of the market value at April 2017.
Is this a simple claim, or are there conditions to be met?
Well, it sounds simple, but there are some pitfalls. The first thing, it's only going to apply to people who are non-DOM in April 2017. It's not going to apply to people who have become non-DOM in the following year, or indeed people who are non-DOM before then. So this seems fairly arbitrary and fairly unfair. That will only really relieve people who become deemed domiciled at one specific point in time. It's only going to be available to people who've paid the remittance basis charge. Now this is quite odd. You would think that if a person had elected to pay tax on their full income, that they might get this relief. They've clearly been a good taxpayer, a good citizen. They may have inherited the family chateau, and so they had no foreign income to declare. It was not necessary for them to claim the remittance basis. Yet even though they inherited this asset, they're then going to find themselves subject to capital gains tax on the full profit once they encash it. What about planning opportunities? Well, I think there's going to be something of a balancing act. Having property or assets in your own name is going to have some specific benefits. So if you can claim the remittance basis charge, then that's fine. You can shelter the gains. Once you can't claim the remittance basis charge, then you can claim the rebasing election, and the profits can be kept offshore. They can be used to fund foreign expenditure, but if you keep it in your own name, it's going to be subject to inheritance tax. So there are going to be some times when, instead of holding assets in your own name, you're going to want to hold them through a trust structure, which will give you some relief from inheritance tax. So long-term assets, you're going to probably want to keep them in a trust and not touch them. And so you leave them in trust, that's for the long-term benefit. Assets that were bought with clean capital in the first place, if you claim the rebasing election, then they could be used to fund UK expenditure. Assets that have been bought using foreign income, well, they're more likely to be used to fund foreign expenditure because the proceeds of the gain will be tainted. It'll contain some of the untaxed capital gains, but it'll also contain some of the foreign income and gains which purchased the asset in the first place. I'm going to try and look at it tax by tax. So I'm going to start by looking at capital gains tax. Now, this is probably one of the most interesting things about the latest consultation, because there's quite a marked shift in what they have done. They've decided to come at things from a very different angle. Now, if we recap a little bit about what the government originally said, they said if you have a trust, as long as the income stays in the trust and the gains stay in the trust, then as long as those are foreign sources, then there would be no tax on the individual. And when they take the money out, wherever that benefit is enjoyed, it would get taxed. Now, the government has obviously looked at this, and they've become very worried about possible tax planning opportunities, where people could have a trust and benefits might get given to non-residents. It would be taxable then on the non-residents, but because they're not resident in the UK, there wouldn't be any UK tax to apply. So the government got very worried about people being able to wash out gains to non-resident beneficiaries. And so they've started thinking again. They've looked at the particular charging provision, which is Section 86 of the TCGA. And Section 86 says that in effect, the trust is transparent for a non-dom. So this is quite bad news. What the government says is that if there's any benefit paid out from the trust, and this either goes to the settler, the settler's wife, or minor children, then Section 86 will apply tax to the settler on the whole gains that there are within the trust. Now, of course, if you think about this, this is quite a significant issue because it will lead to quite a disproportionate charge. This will mean that a beneficiary might enjoy a £50 benefit, yet the whole gains of the trust will become taxable on a UK resident deemed domiciled settler. And this will mean that the protection is lost forever, and they'll continuously be taxed on gains as they arise. This does seem that there are some tax planning opportunities for us. Firstly, trustees should think about making capital distributions. If they're planning to make them anyway this tax year, then perhaps it might be an opportunity to make the distribution before budget day, which is 23rd November next week. The reason why they should make that distribution is there's a realistic prospect that the ability to wash out gains may well be closed on budget day. Secondly, once we know what the legislation looks like, it may be that we need to rethink how we look at trusts, and that maybe we should have some trusts that are piggy banks for the long-term benefit of a family, where they will not be touched in the settler's lifetime, but might be enjoyed after the settler dies. And then perhaps we have other forms of trusts which might be used during the settler's lifetime. Trustees may also want to think about making capital distributions before 5th of April 2017 to fund foreign expenditure. This is because the settler could, or the beneficiary could, take a payment now if they're still non-doms and they can still elect to pay the remittance basis charge. They can take the money out, keep it abroad, pay the remittance basis charge, and use that little pot to fund foreign expenditure going forwards. Okay, so next I'm going to think about the settlement provisions. Now, when the government originally talked about how trusts would be taxed, they said there would be a new benefits charge, and so that if a taxpayer enjoyed a benefit wherever they enjoyed it in the world, then that benefit would be taxed on the settler or the beneficiary, depending on who got it. Now, this resulted in a certain amount of dispute, because there would be many trust structures where they were dry, where there was no income or gains, and that meant there was nothing to fund the tax bill. And so, in consequence of this, the government has abandoned the concept of there being a benefits charge, and they're saying the settlements provision will still apply, but if the trust was set up before the non-dom becomes deemed dom, and providing the settler doesn't add any more money to the trust after he becomes deemed dom, then there'll only be a tax charge when income is distributed. And when it is distributed, it will then look at what type of trust is it. If it is a settler interested trust, then if a payment goes to the settler, his spouse or minor children, and the government also adds a further mystery subject, which is other relevant person, then if money goes to any of those persons, then the settler himself will be subject to tax on that income. I'm now going to think about the transfer of assets abroad regime. Now, this regime applies an income tax charge on a person who's made a transfer of assets abroad. Income arises to a person abroad, and the transferor is some way able to benefit from the income arising from that transfer. At the moment, this tax provision can be relieved by a non-dom claiming the remittance basis. Now, once he can no longer claim the remittance basis, after he's become deemed domicile, we have to ask the question, how is this provision still going to apply? So the government has said there's going to be a measure of protection for people in this situation, that if the money still stays in trust, then there won't be any tax on the transferor. But there's some very specific tweaks in the wording, and I'll read it out. The government intends to achieve this by partially disapplying Section 720, so that's the transfer of assets abroad regime, but for the foreign income of the trust or any underlying entity, but only if the underlying entity pays out dividends to the trust. So it seems that we'll have a very strange situation that if a trust has underlying entities, it's going to be essential that those entities then continue to dividend up their profits into the trust. Otherwise, the protections that are proposed won't apply. UK source income will continue to be taxed as usual, either under the settlements provision or the transfer assets abroad regime, depending on what there is. If the settler's spouse, minor child or other relevant person receives a distribution or otherwise benefit from the trust, then the protected status of the trust is going to get lost.
This represents a fairly significant departure from the government's promise to provide an element of protection for trusts, as it seems it can be so easily lost. Are there any planning opportunities?
Yes, David, I think there still are. I think it's certainly the case that every trust structure needs to be reviewed. Different trusts may have to be formed for different functions. So if we have a trust which is at the moment giving benefits to UK resident beneficiaries and foreign resident beneficiaries, we perhaps should be thinking about dividing trusts up for different purposes. The excluded property status of trusts, which gives shelter from inheritance tax, that's still going to carry on. And so for people who intend to stay in the UK long term, that's still going to give them great opportunities.
When the government announced the reform of non-doms, it was hoped that the protection given to trusts would make it palatable for non-doms to remain in the UK. But it'd be interesting to ask the audience a question on whether they think that changes proposed in the latest consultation document make it more or less likely that non-doms will stay in the UK. You can answer now more likely, less likely, and don't know.
So in our view, I think it's more likely that people will be leaving the UK. The UK is not alone in having a non-dom regime. It exists in Portugal, Malta, Cyprus. The latest in the list is Italy, that they've recently said that they are going to be introducing a non-dom regime. And it seems very odd that at the time that we most need inward investment, that we're reforming our non-dom regime to make it less palatable to stay in the UK. And we certainly don't have the climate and food that Italy does. So we may see an exodus of people to leave. But in my view, I think a lot of these changes that have been suggested in the latest consultation, for instance, with the transparency of trusts, with Section 86 applying, we're going to see some relaxation on that, because I think the rules as they stand are simply not workable. No billionaire is going to stay in the UK where he thinks that there is a risk that his worldwide capital gains may become subject to UK capital gains tax. It simply isn't worth the risk. So either the government needs to relax on that point and perhaps tighten up the rules of Section 87, which will mean that benefits will still get taxed, but the underlying gains might not, or the government is going to see a large number of people leaving. And finally, further advice is being sought on business investment relief. Now, business investment relief is one of those things which very few people generally know about. It allows a non-dom to invest in a qualifying company, either by subscribing for new shares or by making a loan to a qualifying company. And a qualifying company is one which is conducting a qualifying trade. Now, what is interesting about this is that the rules of what constitutes qualifying trade are quite wide, in that it would include all the normal things you'd expect as a trade, but it also includes holding commercial property and holding residential property. Now, this isn't getting used very much. Barely 300 people used it in 2014, yet collectively they still managed to invest nearly £500 million into the UK. And so the government is trying to support this. Now, people are not using this relief because it is complicated. There are very strict time rules on how long can you take before you bring money into the UK. There are strict rules on how long you have to take the money back out of the UK. And there are strict rules on disapplying the relief if any benefit is received from the structure. Now, any benefit could mean being given a pencil, and suddenly a small disproportionate benefit could result in a substantial withdrawal of the relief and a substantial tax bill. So there's been a lot of lobbying by various parties to try and make this relief more attractive. And so we can expect to see perhaps changes here, perhaps relaxing the benefit conditions so that you only pay some tax proportionate to the amount of benefit that you received. There are also rumours that it may be a method by which mixed foreign income and gains could be brought to the UK, invested in a UK qualifying company and kept there for a specific amount of time, and then after a while it may become treated as if it is clean capital. Now, this may be just an idea at this stage, but if this does come about, we may see a lot more planning opportunities here for people to invest in UK companies and look perhaps at having family limited companies as opposed to a trust. So we may see an onshoring of families' wealth in the future.
Thank you, Mark, for that very interesting insight. Thank you for participating in this webinar. We're now open for questions and we'll try and answer as many of them as we can just now.